What's going on, everybody? Michael Silva here. This is where portfolios typically take a turn for the worse because this is where FOMO kicks in, right? This is where the bears really start biting their fingernails. And this is where stock market bulls may have not have caught the move, but yet now they're seeing that Fed pivot in sight and they really want to chase those highs. We got a lot to talk about on today's stock market brief. We are going to be getting into some big picture charts to give you an idea and sense as to where the market is currently and where it could potentially go. We're going to hop right into the Fed Fund futures curve. And you can see here, these are the meeting probabilities. So we have dates for all the Fed meetings. This is where the Fed comes out and says we're raising raising rates, or we're keeping them set, or whatever. As we're seeing now, right, bulls are running to that Fed pivot. Earlier, actually, this thing dropped off about 50 basis points towards the end of the year. But now, as it's settling in right now, the Fed is going to be raising rates, meaning it's going to bring its target rate to 450 to 475 in February. Come March, they're going to raise it again. The probability is to 475 to 500. Okay, that means another 25 basis point hike. So between now and to March, we're looking at 50 basis points of rate hikes, which is a possibility because the Fed has been saying this. But one thing that the Fed has continued to elaborate on was the persistence of keeping at it. All right, from Volcker's old book, Keep at It or whatever. Okay, so he's been quoting Volcker a lot, and as you can see here, they're saying that, hey, the probability of keeping them at 475 to 500, meaning, the pause in rate hikes, is going to be up until December, where we may see a rate cut. I mean, that's, in my opinion, that's not really a pivot. I mean, especially that we're still keeping them at really relatively high. So, but that's what the market's rallying on, right? They're going to cut sooner than later. A lot of people are saying they're going to cut in June. Hey, who knows? That might be a possibility, but as it stands right now, the Fed is still saying the same tune. They're going to be tightening, right? We're seeing that reduction in their balance sheet. We're seeing them saying that they're going to be holding rates for longer, and that is what it is. Now, we have earnings come out on some of the financial names. Took a huge hit right out of the gates, but just look at this like algorithmic type rally for the remainder of the day on pretty much all of the financial stocks. So pretty crazy price action right into there. Next week, or this week, I should say, starting Tuesday, right, we have MS, Morgan Stanley, we have PG, and Netflix also reporting earnings. These are some from the S&P 100. So those should be on watch. As far as what we got going on next week, we do have Wednesday. We have PPI, month over month, or retail sales coming out. That'd be one to watch. We have building permits on Thursday. And what you can see here, every time you see a microphone or a little audio, boom, 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 and shaka boom, shaka boom, shaka boom, shaka boom. Those are Fed speaks, okay? So next week we're just being barraged, whatever the word is, by a bunch of Fed speakers. So I want to take you to some big monthly charts. Big monthly charts meaning that we're looking at, a bigger picture of the overall market. Now we know the S&P 500 currently is up 4.64% month to date, meaning it's up 4.64%, 4.614%. 4.16% year to date, because this is the first month of the trading year. Now, I got some lines on my screens that I want to point your focus towards. This dash line here and this dash line down here, these are quarterly expected moves. This is what the options market priced in for the entire quarter leading up to it, right? So these are the levels, and 68% of the time, typically more than that, especially with the S&P 500, more north of 80% of the time, price will close within this range. So we are well within that range. So now I want to show you this solid black line, this thin solid black line, as you can see going across the screen here. This is the monthly expected move. This is what the options priced in as far as, hey, this is what we perceive as forward volatility or future risk going into the month of January. And where we're trading right now is currently sitting just under that level, which is just over 4,000. Now, also to note, we are just having an inside trading candle. We're back above the red area, which is the bear market territory, measuring, and the way that I measure that is just 20% from its peak. So we're back above that. So that's a positive sign. We're above the 5 monthly EMA. As it stands right now, at least, that's a positive sign. But we're really just having an inside trading week. And, if I go to the Qs, you can see here, people are cheering, screaming, and woo, the bulls are back. But really, if you just take a look, here's 1 month. That's January, right? December, so forth. Boom, boom, boom. I mean, we've been in this area for a very, very long time. So to get overly excited and chase this FOMO without really, seen any big breaks as far as the technical levels, it's something to be a little bit concerning of. Now, we're well into still bear market territory here. And you can see the dash line is the quarterly expected move, which could take us to where? Could take us to the high, basically, of the prior month. And remember, 68% of the time, if you look at a distribution curve, these things that look like these, right? 68% of the time, that's, one standard deviation. Then you have 2 standard deviations, and you have 3 standard deviations, which is pretty rare, okay? So as it stands right now, we're coming up to the monthly expected move. So can this potentially act as a level of resistance? Absolutely can, especially after a very strong move that we've seen already. But where can we watch to make, feel a little bit more confident the bulls are in control? Well, we can definitely try to take out the high and close above the high of the prior month candle. That to me would be a pretty positive sign. IWM is still in bear market territory. It's trading above the monthly expected move, and it's not too far off the quarterly expected move. So where has this thing been going? Every single bear market rally, there's people screaming that, hey, the bear market's over and now it's a bull market, okay? Eventually they're gonna be right. That is gonna be the case. Are they right here? I don't know, but they've been confident here. They've been confident there. They've been confident here. They've been confident everywhere, okay? That is the case, but as it stands right now, we're just in a sideways chop range and we're up to the north side of the overall range right now. So where is the upper expected move for the quarter? I would say just about 195-ish area, right in that area, which we've seen prior price action get rejected, right? Remember this candle right over here quite a while ago. I remember when it was bright green up here, everyone was saying, yes, bull market's back, and then just got a complete slam down. Okay, so we got to remain tactical. We got to play on the shorter time frames to really understand if the market is going to continue its move to the upside. Now let's take a look at a couple other big weekly charts here, and this is really highlighting the 50-period moving average. 50-period, it's the 50-period weekly moving average, and the reason why I'm showing is because it is quite significant on these charts. So you can see here, the 50 weekly, once it broke, right, it came down, it came back, it back tested right here, it hit it perfectly, and now we're coming right back up to it. So it is still trending down, so you'd like to see the weekly price get above it. Already a strong move, right? So you'd want to see it hold, something like that. Something like this on the Dow Jones Industrial Average. You can see it got rejected right over here. Got rejected over here, finally broke above it, and look how it came back and back tested. It started to flatten out. So this is actually a pretty positive sign overall, as long as it could hold it. So from a technical standpoint, where would you get bearish? I would get bearish if it started getting below 32.5, right? If it gets above there, that's also positive. As it stands right now, we're in a chop range. So watch this, set an alert, right? Set an alert at 32.5. If the Dow Jones Industrial Average breaks that, that could be a bad sign where we can see further downside there. Now, if we take a look at the NASDAQ 100, we broke down through the 50-period weekly moving average, back tested it once, didn't make up to it, and now we're shooting off. We had that big week, right? 4.54% in the NASDAQ 100. But be aware of where this is coming from, right? People are like, see, everything's coming back. But really, I mean, why are things moving up? Well, things are moving up because they sold off so hard. Just take a look at Tesla, take a look at Google, take a look at Microsoft. I mean, nobody was saying anything when they were falling off a cliff, but all of a sudden they have 4 or 5 up days in a row coming off oversold territory, which I'll prove to you because we talked about things getting oversold, and now we're going to talk about things getting overbought because that's just what's taking place on these charts. So keep an eye on that declining 50-period weekly moving average over there. If we take a look at the XLK, which is the one of the sectors in the S&P 500, this is a spider ETF. You can see we broke down over here. We back tested it once. We back tested it. It was rejected. And now we're trying to strike up for it again. This is still a declining period moving average, right? So, even if we get price above it, if it's still declining, right? Like it's not something that you want to just trust right away. You want to see this flatten out and you want to start seeing it curve up. That would be a much more positive sign. Now, if we take a look at XLY, same situation. We broke down, it was rejected, and now we're pretty far off of it still, which means, hey, if we come all the way back up here, that's a big, strong move and it's going to bring more bulls into the situation, but we're still below a declining 50-week moving average. So it tells me that, hey, there could still be potentially a lot of more downside if these things hold as levels of resistance. Look at how oversold we were here, right? And we had this low, then we broke down, we had a positive divergence, right? A little bullish crossover taking place. So yeah, you can see it bounce up, but does that do anything technically to really help the situation? From my standpoint, no, not as of right now, because we're still seeing a series of lower highs and lower lows. Okay, that's not me being biased or making it up. That's just what's on the chart. Lower highs, okay, a high. What's this? That's a lower high. What's this? That's a lower high. What's this? That's a lower high. Okay. What's this? That's a low. Okay. What's that? That's a lower low. Oh, okay. What's that? A lower low. Oh, what's that? A lower low. So that is what we're seeing. A series of lower highs and lower lows. People like to argue with me back and forth. No, it's a bull trend now. No, it's not a bull trend, especially on this time frame. Now, if you go into smaller time frames, it's a different situation. Now, what should we pay attention to? We just showed XLK, XLY. These are the relative strength lines, okay? The reason why I'm showing you these is because the TNX, the 10-year yield, has a pretty strong impact on these sectors, right? You're talking when the 10-year yield spikes up at a rapid rate of change, it affects growth stocks. Oh, go figure, right? They have, a lot of debt, and when the debt becomes more expensive, they struggle, at least from this relative standpoint and what we've seen from an absolute standpoint too. So you can see here, the 10-year yield ripped to the upside. What happened to the relative performance of XLK relative to SPY and XLY relative to SPY? Well, they went down. Now, if the 10-year yield wants to start coming back, because it's been backing off, right? We take a look here. We backed off these last couple of weeks. What happened here with the relative strength? It picked up, right? And we're seeing things bounce. Okay, well, let's take a look at the chart of the 10-year yield. Okay, so the 10-year yield has been backing off, and guess what sectors have been performing pretty well? The ones that we just mentioned, right? They're bouncing from oversold conditions. Okay, cool. So what's going on here on this daily chart on the 10-year yield? Well, the 10-year yield is pulling back into a prior area of support where it bounced from prior. And then it's coming right back into it right now. Okay, well, remember, resistance, once broken, boom, boom, can become a level of support. It did. So we're back down to another level of support. The candle actually on this last trading day was actually bullish. It was up on the day, which is interesting because also big tech and all this stuff was. So is this a sign where we might see a pop here and potentially see the relative strength come off of these names? It's always a possibility. We do have a positive divergence building on both the price momentum oscillator and the relative strength index there too as well. Another thing to keep eye on is the correlation between the dollar and the S&P 500. Now, we haven't been talking about this all too much because the correlation wasn't really there. But now take a look here on the shorter time frame, 15-day time frame of the correlation to the dollar. So shorter time frame has a very strong negative correlation back at minus 0.9. Okay, so that means when the dollar goes up, the S&P 500 on the shorter time frame can very well go down. And you can see that here. The dollar's been getting crushed, right? Boom, crushed. S&P 500 has been moving up. This chop right here really took that correlation kind of out of whack a little bit, but now the correlation is back. So if the dollar wants to find some strength here, the S&P 500 could back off, and we'll map out some key levels there too. Let's take a look at a couple other sectors on the bigger time frame. XLV, right? This is always a decent play in times of recessionary times or poor economic conditions. There's three defensive sectors really. XLV, right? Healthcare, utilities, consumer staples are typically pretty good, at least from a relative standpoint. We're looking at an absolute standpoint right now, but a weekly time frame, okay? We're really overall just in this chop box, right? But we've seen a pretty strong move up, and now this strong move is being consolidated. We've now had 3 weeks that are little tiny hammer candles, meaning that we've seen just red all week, boom, but then the bulls step it back up. Red, big red candle, bulls stepped it up. This last week, same thing. It was a big red candle. The bulls stepped it right back up. So I think that if we can break above these prior weekly highs over here, that might send us for a little bit of a pop there in healthcare names. So be on the lookout for healthcare names. It's a possibility. I can also show you this. This is I shared all these charts, the advanced decline charts for the 11 sectors with my Patreon group this last week. And I wanted to just point out here, because you can find positive divergences and negative divergences within this data. So here is the XLV cumulative advanced decline line, and then up here is the XLV. And I want to show you that, hey, okay, we have a low, and even one of my members saw this too. This is, it's great because they call this stuff out. You have a low and then a lower low, but hey, take a look at the cumulative line here. You have a low and a higher low. So really you see a positive divergence building here. So if it starts breaking out of this potential wedge, that might send us there too, and we've already talked about it being a potential for a flag right there. So that is a positive sign as it stands right now. If we take a look at something like consumer staples, very same situation. You get this sideways chop action for quite some time. This is on the weekly chart. This could be very well flagging. We backed off a little bit last week. And you could see here we do have a positive divergence there too as well in the advanced decline. We have, a low to lower lows. It's pretty much flat. And then we have a subtle higher low right there in the cumulative line. So you'd want to see this pop to the upside to give us maybe insight that we can start heading higher there. From a negative note, though, if you look at the relative strength line between XLP, consumer staples, relative to SPY, we did talk recently about this negative divergence on the RSI and negative divergence on the rate of change. Okay, the reason why I pointed this out is because this was a big tell leading into 2022, while I was saying consumer staples could be a good place to be. And they were. Well, what did I see? Well, I saw this positive divergence here on the RSI, and then the relative strength line continued to die off, and then the positive divergence on the rate of change. So then in 2022, when this played out to the upside, look at that relative strength in consumer staples relative to SPY. It was a huge move right there. All right, so let's continue on and we'll take a look at utilities. Utilities is kind of stalling out here too. Not the greatest looking candle, small body, a little really indecisive, so it might need more time. But overall, it could be an ascending, ascending triangle here. And it's overall, like it's in, if you look at the 50 period weekly moving average, it's above that and it's still trending up, which is a positive sign. Let's take a look into the S&P 500 now. Okay, there's a lot of stuff going on my screen. First off, we'll talk about the blue lines. The blue lines just represent the trend line that everyone sees, right? Everyone sees this trend line. Yeah, we get it. Okay, it tested, and now we're back again testing it again. No surprise there, right? And now we're breaking above the 200 period weekly moving average, that the red line. So everyone's cheering. Be aware that we've gotten pops above it before and we got fakes out, right? It's still declining. That's why we need to be careful. Remember, over here, everyone was saying the bull market was over, or the bear market was over. Over here, they're saying we're going to new time high, all highs. Over here, same situation, then we started selling off. Okay, these things happen. They drive FOMO, they drive fear. This is why the bears right now on this move up are biting their fingernails, and this is why other people are saying, should we just pile in right now? Okay, patience, because patience is required. Okay, these dash lines, this is the expected move for the week. It's going to be smaller this week because we have a shortened trading week, okay? Doesn't mean that volatility can't pop its head right back in. But we're looking at just above 40.50 and to the downside just below 39.50 as far as the expected move. Now I measured out this kind of like chop box area here, highlighted in pink. Why? Well, okay, let's take a look at 3,900. We all know 3,900 has been a very impactful level, right? 3,900, you can see it acted as support. When it broke down, it acted as resistance. When it broke up, support. When it broke out, resistance, support. And then finally, really, it wasn't until like 4 days ago when it actually, this rally that we're seeing kicked into place because we got back above that 3,900 and then we saw it push higher. So the reason why I'm calling this out is because if you look at terms of probabilities, at 3,900 is kind of like this magnet, right? So it's possible that we can pull back into this, and we'll look at the smaller time frame to get a good idea as to, hey, is that still in a short-term bullish trend? But that's a possibility. Now to the upside, we have prior support. And then when we broke down, it acted as resistance. You can see this massive candle here, area of supply, so resistance. So coming up into, which you probably heard this number too, 4,200. A lot of people eyes are on that, okay, can pop up into this level. But there's a lot of areas to be mindful of, right? We get above these trends, we get above the 200 weekly, it might create more excitement, come up to 4,200. But still, at that point, okay, where you can do some short-term tradings and do well. Do not lose your sense of reality as to where we still are. Even if we were to come up into 4,200, that would just once again be another lower high, and we would have a series of lower lows still intact. Okay? Yes, this would be a low and this would be technically a higher low, but we'd still have lower highs still intact. So we must be aware and grounded in reality, because as it stands right now, the Fed is continuing its tightening cycle, right? It is still holding rates there for longer. And when you do that, you get more volatility in the system, okay? Now, let's take a look at the 15-minute time frame. 15-minute time frame, we're above an inclining 5-day moving average. Once again, I'll point it out. The 5-day was declining. While it was over into this area, we said we wanted to see it flatten out, right? And price to do something like this. And that's what it did. It took a while to do it. It built up all this, just open interest over here, and we're getting a squeeze, right? Squeeze, and it's really driven by a lot of zero-date options. I saw some interesting charts on Twitter about these, just the amount of zero-date options being traded right now. It's crazy. It's incredible, and it's creating these massive moves. Okay, so as long as we can stay above this 5-day moving average, awesome. But remember, if we start getting below it, and this starts flattening out, and this starts curling back over, okay, that's when you can become a little bit more bearish. Okay, the bulls are in control right here. Don't ignore that. You can keep on trying to fade it, but it can keep pushing, right? It can keep pushing. You want price action to show on this shorter time frame, not higher highs and higher lows. Go figure, right? Just like the longer time. If we start getting lower lows and lower highs, okay, then we can create trade ideas there from that perspective, from more of the bearish. Now, people do like to fade. I like to fade, but I'm a lot more quicker and agile when it comes to fading stocks, meaning if it's a very strong move, I might take profits incredibly fast because I'm going against a trend, okay? If we go on now, I want to show you something. Now, this isn't really bigger picture stuff, but this is just showing you this, this rally that we're seeing, and everyone's like, oh, now it's finally here. Well, all we did was get overextended to the downside, and we're rotating back up to overextended to the upside. That's it. And it does it over and over and over and over again. So there's nothing new. Leading into 2023, we said things are overextended. We were talking about the Santa Claus rally and all that stuff, which didn't come, but it came later, and we got the rally. Right? And that held true because things were lighting up really green on my zones. It was lighting up right down here into these lower ranges. And now we're talking about it being up here. That's just what it is. And typically when things get up here, people don't want to believe it. But when things get down here, people get incredibly bearish and they don't want to believe that the market can potentially go up. That just is what it is. BPNYA. So that was the COMPQ, right? The Nasdaq Composite. We talked about the bullish positive divergence leading into 2023. We're getting the rally. Yay, we're getting the rally. Boom. But now where are we? Oh, we're getting overextended. Okay, so that's where we are currently there. BPSPX chart still has some room to go. BPNDX chart still has a lot of room to go if it wants to continue to rally. So those are positive signs for both those two, but the broader markets are getting a little frothy. And we're hearing a lot about breadth thrusts, okay? But the breadth thrusts that we're getting are in a lot of cruddy names, profitless names. So if really earnings start coming out very bad, it could wipe away all of the talk about breadth thrust and all of that stuff. Okay, so it's not a time to get overly crazy. As it stands now, the bulls are still in control, so it's good to have some exposure from the long side, but also while you're trading from the long side, make sure that you're updating your stops. Okay, that's, tightening your risk parameters, meaning you're taking some profits or you're just updating your stops. Okay, that is one thing to pay attention to there. If we take a look at more breadth type of indicators, right, new highs versus new lows, we're getting more new highs in the NASDAQ for quite some time. Now, I do want to call out that every time we got new highs in 2022 versus new lows, it marked tops, right? Boom, 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 boom. And now we're finally getting a breadth thrust here where, hey, it's, the market's going up. So we'll continue to monitor this and see what develops here. But, this is technically a positive sign, right? Seeing this is a good sign, but it doesn't just go straight up in a straight line like this. It's not going to, especially with what the Fed is currently doing. We'll see more volatility. We'll have more entry points. If this is actually a market bottom, there's going to be so many opportunities. It's going to be mind-blowing. So be aware of that. And then the last one is also the growth versus value line, right? I have it hidden, but this is the Qs over here. And then I put a rate of change down here. And then I put the RSI up here. And we were talking about the positive divergence that was forming on the rate of change. Positive divergence on the RSI. And guess what? The market started rallying in growth names versus value, right? It started outperforming, and we saw what? A big move in the Qs, right? They were overextended to the downside. They're starting to rally. This thing is actually starting to turn back over, surprisingly, which could mark another sell type of indicator where we get these strong moves, and then the rate of change crosses down through zero. So it's going to be interesting to see how the next week opens up. Okay, the last thing I want to talk about is back month versus front month volatility. This right here is the yellow line, and then behind that is just the VIX. Okay, the VIX got absolutely crushed down towards the 18 handle. People are like, oh my God, but so all these narratives, all this, all that, it probably has a lot to do with all the zero data options and all this crazy stuff and going on. I don't care. Let's take a look here at the back month versus front month. This yellow line, I'll show you here. When it comes up to about 1.2, right about 1.2, 1.2. That has marked the top of these bear market rallies. So as it stands now, it'd be nice to see this get up a little bit higher to potentially mark some sort of a top here in this move. So we'll keep an eye on that if that is actually the case. But that gets a little frothy up in those areas, at least it has in the prior year. Okay, so we'll watch that, see what develops there. That could potentially mark a topping point. That's all I got for you on today's show, everybody. Hope the big picture really helped see the bigger picture of what's going on and zooming into the smaller time frames, because that's the reality of this situation, people. You can have bull markets in short time frames in an overall bear market. That's a possibility. But as it stands now, in the longer time frames, we see bear markets, and in the shorter time frames, we're starting to get FOMO, right? Starting to get that, the nail biting of the bears and so forth. Hope that helps. See y'all later.